Hey everyone, welcome back to the channel. I am joined by a very special guest. I'm here with Adam from the Parallel Wealth YouTube channel, pretty popular YouTube channel. And I think it's a great fit for the channel, obviously, because a lot of my viewers and audience members are folks who are about to retire, who are already retired, and are looking into the RRSP versus LIRA. And what better person to ask than Adam for all these, RSP tricks and best drawdown and
All the secret
taxes,
sauce.
all the secret sauce. So
Yeah.
thanks a lot for doing this, and I'm excited to come also on your channel as well, and we'll do
Mhm.
this. Well, I'll talk about my investing style, et cetera, et cetera. So let's just start off. Quickly introduce yourself and maybe the channel and what your channel is all about.
For sure. Yeah. So, like you said, I own Parallel Wealth, which is a financial planning firm out just outside Vancouver, BC, Canada. And we help people right across Canada. So it's not just actually most of our clients are in Ontario, just because that's the center of the universe. But we have clients right across Canada. And our focus is really the decumulation or the retirement phase. So building out retirement plans for people that are either have Canadian income, so they might be retiring abroad,
Yeah.
or retiring in Canada, just helping them map that out. So we have a team here, a growing team as well, that focuses on the financial planning side. We don't have in-house products. We don't sell anything to you. So we kind of have a big part of our business is just fee-for-service planning, where people come to us, they're looking for help. We charge them a fee up front, and we build out kind of a comprehensive retirement tax and estate plan for them, and just get them on their way. Again, especially a lot of viewers of this channel, DIY, doing their own thing, and they love the passive investing, but they kind of skip out on a lot of those people have moved from like mutual funds at the bank to passive investing, but they've
Managing their
missed this
own
middle ground
RSP.
of like, hey, there's actually like tax and retirement planning that can be very effective and save you. Typically our clients are saving them north of six figures. Like there's a big savings in the middle. A lot of people skip that. So that's kind of where we're trying to fill that gap, saying, look, you can come and just pay a fee. I know you don't want to pay ongoing, a lot of viewers, but you can pay a fee, get a plan, save some money, and then kind of go on your way for into and through retirement.
Yeah, might be well worth it. So we'll discuss all
Yeah.
about some of these tips and tricks, which a lot of the stuff, I was watching some of your videos, a lot of stuff I didn't know about when it comes to the RSP. So hopefully we'll get into that. Let's just start, very generic. I mean, you're an RRSP, a LIRA expert, as well as TFSA. You have TFSA videos as well. So what are the top three mistakes or misconceptions people have about the RRSP per se?
Yeah, for sure. I think one of the big things we see as far as like, I'll start kind of the younger people and then work my way up in the three. I think younger people are people that are still working, haven't entered retirement yet. A lot of people don't take advantage of their RSP matching. So maybe not a misconception, but definitely a huge mistake in that, they have a work RSP plan and then get, a 2 or 3 or 5% matching, which is basically a 5% rate. So yes, you have to put in 5, but you're going to get 5 in return.
Yeah.
So I think one of the biggest mistakes around RSP is actually tied to group RSPs, which there's not a lot of companies that have defined benefit pension plans anymore. It's mostly the group RSP side. And most of those have some sort of matching component to it. So if you have an RSP at work, just make sure you're matching or maxing out the matching component to it. So that would be the first kind of mistake or misconception.
Completely agree. By the way, I was at Air Canada and it was 6%. You put in 6, they'll give you 6. I always suggest people, yes, we're all about do-it-yourself investing, and you have to go typically in their mutual funds, or you could pick some mutual funds. But hey, it's free money. If they match 6, put in 6. If they match 5, put in 5. I always say it's free money. So I completely agree with the first point.
Yeah, it may not be your investing style, but I think we can all agree that we like 100% return in year one, and that's what it is, right? So
Yes.
we
Yeah.
never disagree with that. The second thing, they're not worth it. So a lot of people say, RSPs aren't worth it. Yeah, we get a tax break now, but we got to pay tax when we pull it out in retirement. And it's just like, it makes no sense, right? And
Right.
typically we hear that from retirees, right? Because they're in retirement. And when we build the plan, it's like, yeah, you got to pull out of the RSP or the RIF, and it's going to be taxable income. And they're like, I should have never done this. It's like, yeah, but you forget that you got like 30, 40, 45% back,
Yeah.
and your money's been growing tax deferred to this point. Like, anyway, for some clients, we have to kind of map it back and say, look, you've saved a lot of money utilizing the RSP, but definitely a misconception of, especially when you get to retirement, it's like, stupid thing I got to pay tax on. Like, I should have never done
Yeah,
this.
I hear it all the time. I hear it all the time. So big
It's,
mistake. Very, very powerful tool. Shouldn't be ignored. Completely agree.
yeah.
I mean,
And that's where in the financial plan we'll show them like, look, no, you're paying this amount of tax before and like your marginal tax rate, and here's your average tax rate now. There's a big spread. That spread helps you. And then of course the growth tax deferred helps you as well. The third big mistake would be my RSP is too big, right? We get that a lot. It's like, I got 700 grand in my RSP. It's too big. It's going to be a big tax issue. Look, we've done plans for clients with 3 million in their RSPs, and we're still able to like pull it out tax efficiently. I always say, if you have 3 million, and we've had a few of these, if you have 3 million in RSP, you've done lucky. Most of it was, we had one with Tesla, one another stock, right? So they hit a home run.
yeah,
That's, you're going to pay a bit of tax pulling that out. It's a pretty good tax problem. I think most people would like that. But your typical person that just, didn't have a defined benefit and they just plugged away and tried to save tax along the way. Yeah, when you get to retirement, you have a big RSP. You can still kind of what we call melt that down pretty tax efficiently.
yeah, and we'll definitely get into that for sure. That's one of the top reasons why I wanted to have you, because I get it all the time. What's the most tax efficient way to melt down or draw down your RSP? I can't wait to get into it. So yeah, I completely agree. So those are three, right? You covered three, I believe.
Yeah,
perfect. Yeah, I completely agree. I mean, typical misconceptions that I also deal with. So when it comes to the RRSP, how would you compare it to the LIRA? So you got the LIRA, which is the locked in RRSP, very, very similar. What are the major differences? As far as I know, I think the LIRA just works the same way. It's a bit more strict. You could only take the minimums and you have to wait till 55, I believe. So you're the expert. What's the differences?
Yeah, I mean, the age. So you have to wait till 55 typically for the LIRA to convert to a LIF to start taking out. Really, the biggest difference is when an RRSP goes to a RIF, a retirement income fund.
Yeah.
And a LIRA goes to a LIF, a life income fund. So that's like they convert to a different type of account. A RIF and a LIF have the same minimum. So it's based on the account value and your age. It's going to give you a minimum that you have to take out every year. The difference is with the RIF, you have no limit on the high side. You could take out 100% of your RIF account. It's taxable income. Obviously, you probably don't want to do that, but you can. With the LIF account, you have a maximum amount. So you're capped on the high side. That's the biggest difference between them. The other difference is when you convert a LIRA to a LIF, depending on which province it's legislated in, you can typically unlock 50 to 100% of that account. And when I say unlock, it means moving it from the LIRA, and instead of going into the LIF, it would go into an RSP or RIF. So you can unlock it so you have more flexibility. So in essence, like at a high level, RRSP versus LIRA, the LIRA, it's a bit more constrained on when you go pull that money out down the road.
Okay. And what is the maximum? Because I didn't know that the LIRA has max, RIF, I understand RSP RIF, you could take out the whole thing in the first year if you want. Obviously you'll get taxed on all of it. But is there a chart or someplace where people can check what the maximum withdrawal is?
I mean, if you just Google like max LIF withdrawal age, whatever age you are, it'll pop up on Google right away. Yeah. So it's based on your age and the account value. So it works much the same as the minimum. It's just on the high side.
Okay. Yeah. And as far as moving your LIRA or your LIF money towards your RRSP, that you said depends on the province. And do you have to wait until a certain age to do that?
55 typically. Actually, if you go, we have a website where we kind of have a cheat sheet, just parallelwealth.com/LIRA. And we kind of have every province or federally legislated LIRA, what you can do at what age and all that. Like in BC, if you have a BC legislated LIRA, you can't unlock any of it. So we have a client right now just came over with $1 million in a BC LIRA, it's in a BC LIRA. Like there's a minimum, there's a maximum, like it's very constrained. So that's, that's one thing to consider. If you're in Saskatchewan and Manitoba, you're going to unlock 100% of it. So Ontario is 50% for all you there. So every province territory is a little bit different. The territories are federally legislated, so it's typically 50%. So again, first step one is to know where is my LIRA registered, and then B, figure out, can I unlock it? And how you unlock it, we have a few videos on our channel on that, but it's basically what you want to do is when you convert it from a LIRA to a LIF, part of that application process is, do you want to unlock any of it? And you always say yes, like always unlock it, because it just gives you more flexibility.
Interesting. Good
Yeah.
tip.
Yeah.
Perfect. I'm learning, man. I'm super happy that I had you on.
Yeah.
So the next question is literally the number one question I
Mhm.
get, probably the number one question you get as well. The RRSP drawdown or meltdown advice strategy to save on taxes. So
Mhm.
what's your top advice, or what's some strategies that, I'm sure it's individual to individual, province to province, but what would you say are your top three tips or strategies to melt it down the most tax efficiently as possible?
Yeah. So when we build a plan, it really client to client changes for sure, but the strategy is typically the same. And a
Mm-hmm.
few things. You want to level out your average tax rate. So when you hit retirement, when we build out a financial plan, if we can level out your average or your effective tax rate to within like 2, 3, 4% right through retirement or to life expectancy, like mid 80s, that's typically and always a very efficient plan. So leveling out that average tax rate. Now, how do you do that? A few things. You want to defer your CPP. And trust me, you'll get more comments on deferring CPP than anything else because people say, no, I turned 60, I've paid into the government. What happens if I die at 61? I always say, look, with CPP, there's I want my money and there's I want the most amount of money. You
Yeah.
have to decide which one you want. Of course, if you have a health issue, like there's the odd cases, but 99% of the time, you will have the most money in your pocket from date of retirement to the date you die if you defer your CPP closer to 70. It's just statistically, that's the numbers. So, if you're, let's say you're 60 years old, Adrian, coming to us, let's say, let's draw down your RSP from 60 to 70. And then if you still have RSP, depending on how much you have in there, we'll scale back on the RSP and start your CPP. So when you talk about like how do you melt down the RSP, typically it's by deferring CPP, potentially deferring your old age security as well, but CPP much bigger advantage than old age security, and then using your RSP. What that does is, a lot of people complain, I don't have a defined benefit pension plan. And
Yeah.
I get that, but your CPP is really a defined benefit pension plan. So if we can defer that and let it grow and compound and work with inflation and all of that, and draw down our money in a more efficient way and actually take some of the risk off of us, because the less money we manage, the more we have in a guaranteed pension in the CPP,
Right. I
the
see.
less stress we're going to have later in life. Now,
That-
a lot of your viewers on the passive investing say, yeah, but Adam, I get 10, 12, 15%. Like I'm living off the interest. I'm not drawing down my account. So, and again, we've done lots of plans for your viewers. And here's the difference. I'm not saying you have to draw out the money to live off of, but you have to draw down your RSP to trigger the tax bill. And there's a big difference between the two. So if you had, let's say for simple math, $1 million in your RSP that was generating 10% a year, and you're like,
yeah.
my 100 grand, that's all I need. So I'm not going to touch the principal. Well, what happens is if you just live off that 100 that's pulling out of there, and sure, there's some tax and all that in there, but that $1 million RSP just keeps, maybe it stays at a million, just goes,
It stays a
and then you
million. Yeah.
die, and half of it goes to CRA. So we can show you that. Look, if you leave it there, here's what your tax bill is and income and structure and all that. Then we say, let's like start pulling out of there and not spending it, but let's just reallocate it into your non-registered account. And we'll show you how the tax difference works, how your estate's going to be a bit better off, how we can level
Yeah.
out that tax bill. So that's the concept behind it. And I think a lot of people that do the passive investing, the concept is like, I'm not touching principal, I'm just living off the income, which makes so much sense to me.
That's one of my golden rules. Yeah.
100%. But if you ignore the fact that you have a big bucket of RSPs, for most of your clients, they would, if we don't start like strategizing around the tax, and again, it's not taking it out to spend it, it's I'm going to move it from RSP bucket over to the TFSA or the non-reg or
TFSA or
whatever.
non-reg, yeah. Even if you don't,
Yeah,
I tell people all the time, just because you're extracting it in cash doesn't mean you have to spend it. You could put some in your TFSA, always max out your TFSA, of course, before you put it in your non-reg, but you could do
exactly.
that. And I'm assuming here the practical or the advice is really to draw down the RRSP first, let's say from 60 to 70, not take the CPP and OAS, because that adds to your, if you take that, that adds to your marginal tax rate.
Exactly.
Right? Is that
Yeah.
what I'm understanding that, right? So you draw down your RRSP when you're in a lower tax bracket because you're probably not working. You don't have the CPP coming in yet, so you're getting taxed less on those withdrawals, and then wait till 70 for the CPP, and you'll have the maximum CPP amount.
Exactly. And again, everyone's situation is different, but
yeah,
I do know the few passive investing clients, quite a few, it's always around, okay, but I'm generating enough to live off of. And it's like, okay, but that's one conversation. I want to look at the tax situation. And this is where like going through the process with a financial planner that understands like how to build these out. It's like, we'll show you like, okay, if you keep going the path that you're going, here's what it looks like. Or if you like rejig a little bit, and here's the benefit. Like, here's like the tax you're saving, the added income in your pocket, the estate benefit. So those are the three things we really look at. So again, delaying CPP, melting down that RSP. Another thing that we like to do is like what we call the laddered income strategy. And, a bit of tax planning, but more just like general retirement planning. And the concept there is like, when you retire at 60, from 60 to 75, you're going to spend more than in your 90s.
Yeah.
You just will, right? So why would we not build a plan that gives you more income early and with the peace of mind that you're still going to be okay later in life? And so when you build out a retirement plan, the plan should reflect that. Like, instead of saying, hey, you can have 90 grand for the rest of your life. It's like, no, I want 105 now, and then I want 80, and then I want 60, and then I want to leave a bit to my estate. Well, let's build it out that way, because that's probably how you're going to spend it. So I think a lot of people miss that. They miss the actual, like, the proper cash flow planning within the overall plan itself.
Yeah, it makes perfect sense. Makes perfect sense to me. I mean, yeah, you want to enjoy your life too, right? So especially in retirement, you're probably more able to enjoy, go on vacation, go on cruises, go on tours in your 60s, not really in your 90s. It's kind of like, unless you have someone pushing you around in a wheelchair. But
yeah, exactly. 71 to 73. Sense. There's a lot of data out there. 71 to 73 is kind of when the travel, the spending starts to like drop off a cliff.
Yeah, because you probably have more of a chance of health issues and mobility issues and things like that. Yeah, I'm all about enjoying life to the fullest. I mean, that's a clear...
You live in Panama, clearly.
Yeah, I mean, life is short. I mean, it's simple math, right? So yeah, I completely agree. So it's good points that you're making. Plus, even if you don't touch the capital, like you said, when you die, half of it goes to the CRA, right? So you want to try to avoid that. So awesome, really, really good tips. And of course, you have a service where you do an analytical analysis of everyone personally and give them, your recommendations. I think it's a pretty good service. Okay, well, thanks for that. Another question I had, just quickly, RSP secrets. So if I remember, I saw a video that even I had no idea about this. I think if you, by age 65, if you withdraw up to $2,000 from your RRSP, you could do it tax-free. Can you explain that?
Yeah, so in Canada, there's something called the pension income tax credit. And that's basically the first
tax credit. Okay.
Yeah. And that's the first 2,000 of pensionable income. And just Google, CRA pensionable income, but RRSP or RIF, you have to convert it to a RIF income. The first 2,000 would qualify for that. Now, you can pull it forward and give the other two to your spouse if you have a spouse or common law partner. Like, there's kind of strategy around that. But yeah, so the first 2,000 of RIF income. If you have a pension plan earlier, there's some uses for that. The credit can apply a bit earlier. And then pension income split, and this is another big one. So you can split RIF income past 65. So that's another thing that people aren't aware of. People always ask, I'm 65, I don't need the RSP. Why convert to a RIF? Well, pension income tax credit is number one. And then the income splitting would be number two.
Yeah. Okay. Income splitting. Okay. So if there's a breadwinner has a giant RIF, the spouse doesn't have anything, you could split that to lower your tax bill.
Exactly. And that's, people always ask me, like, when should I get a plan done? And ideally, most people come to us like 2 years until they retire or 2 years into retirement. But 5 to 10 years is perfect, because if you do have that breadwinner with like the big RSP and you map it out for them and you're like, okay, you want to retire at 60, but from 60 to 65, all the income's yours. Like, all the RSP is yours, which means all the income's yours. So then you shift to, okay, let's build up a spousal RSP, kind of top that up. You got to leave it for 3 years before you can pull it out. So you have more time to kind of build in the tax plan, right? But once you hit 65, I could pull out, if I was 65, I could pull out 100,000 out of my RIF, and I could, give 50,000 of that to my wife for income tax purposes.
Yeah. So it's important to also have a good accountant who knows about all this stuff.
Yeah, I mean,
Right?
accountants know it typically, but again, it comes into planning, like the Spal's RSP and structure. Accountants don't do that. This is where I think there's a misconception out there of like people have the old mindset, and I'm sure most of your viewers, it's like, oh yeah, I dealt with a financial advisor at the bank and they were awful and they gave no advice and I paid them a fee.
Right.
This is where we're trying to like help educate. And this is where I love YouTube, because we can actually get on here and say, look, like not all financial, like a lot of your financial advisors at the bank did a 1 week course and they're not qualified to tell you anything. Whereas if you find, like, I have my CFP, so certified financial planner designation, I have an estate planning designation as well. Like we've gone through a lot of education and learning and been doing this for almost 20 years.
Yeah.
There's value in good advice. There really is. And so stuff like this, accountants don't do. It's financial planners, but you have to find a financial planner that understands it and has you on their side. Whereas a lot of financial advisors that work for big companies, they put them first, then their company, and then you, right? So there has to be fiduciary duty of client first, and then everything else from there.
Yeah, it's a good point. And that trust is lacking a lot in the industry, right? When it comes to that stuff.
Like huge. So, and I don't blame the end consumer, like viewers of your channel. I don't blame them. Like our industry is maybe a step above a lawyer, but not much, right? So
yeah, no, for sure, for sure. Okay, last question I had is regarding, me personally, myself, I tend to invest in US listed stocks, mostly in the RRSP, because the RRSP is the account that has, is completely immune to the 15% withholding tax on any income. And if you're an income investor, it's a pretty big deal because most of your returns are coming from the income. So I typically invest US dollars in US stocks. So does that make a difference at all at the time of, if when it becomes a RIF and you're withdrawing, let's say you're withdrawing USD instead of Canadian dollars, is it still just taxed that you're at the marginal tax rate that year, or does the government do like a conversion, or, I mean, how does that work?
Yeah, so it's actually your broker. Yeah, no, yeah, for sure. So it's actually your brokerage, wherever you do your brokerage through, will do the conversion. So there's kind of a few, like we have clients. So most of our clients are at an investment firm that we refer to out in Winnipeg. And so it's like blue chip dividend paying stuff. So they use National Bank, so NBIN, as their custodian. And so typically most of our clients that have, like, let's say a RIF, a US dollar RIF with US investments, if they're going to draw money out of there, we can either convert it back to Canadian, but of course you're paying the FX. So you paid the FX going in, now you're paying it coming out. Better option would be we can link a US dollar bank account. So a lot of our clients travel down south, they could use the US dollars. Exactly. So yeah, we'll redeem it, but keep it in USD and move it to a USD account. But what National Bank will do, or NBIN will do, is they always convert it back to Canadian, because you need a Canadian tax slip. So if you pull out whatever, $10,000 from your, like, you sell Microsoft shares and get $10,000, but you keep it in USD, your tax slip will say you drew 13,500 or whatever the exchange is on that day. So it's always converted back on that day. The exchange rate that day is basically how it's like earmarked in the system for tax purposes. But you can collect it as 10,000 USD as long as you have it set up. Again, every brokerage is going to be a little bit differently, but it's always converted back to Canadian dollar on the day that you do the transaction.
For tax purposes.
For tax purposes.
But you could withdraw it. Let's say I take out $1,500 from my RIF in USD. I could transfer it to a US bank account, or, a TD. TD has a USD bank account.
Yeah.
Keep it in 1,500, but on the tax slip, it's going to be,
$2,000 or whatever.
$2,000.
Yeah.
Okay.
Yeah.
That actually answers my question, and I'm glad we went over that, because it's for me personally, and I don't know, I think I'm going to start maybe pulling it out at 55, so it's like in 18 years or something like that. So
yeah, no, for sure. Okay. And like the FX, I mean, the banks make so much money on currency exchange. It's ridiculous. So anytime that we can, I mean, I think any viewer on your channel, my channel, anyone, we all want to pay less fees. And that's why a lot of people move out of mutual funds. But then they get into like trading. And I mean, I know you've talked a little bit about this. Brandon Beavis talks a lot about this too. It's like they're swapping money from CAD to US to CAD. It's like you're paying, like Simple, for instance, they make their money, like almost all their money on FX.
Yeah.
And they're making money. Trust me, they're making money. So like, it's the FX that kills you. So if you can set up a structure where if you're going to use the US dollar, not everyone does, but if you're going to set up that US dollar bank account, link it, and you can receive your payment in USD, keep it in USD, save your 2%.
Yeah. Yeah. If you look at the Google rate, for some reason, you check the banks, it's always three cents more. So they make a crap ton of money with FX conversion for sure, for sure, for sure. So good advice. Well, listen, man, it was great having you. I hope you come back soon. If anyone has any questions, put them in the comment section below. And of course, check out Adam's channel. It's a really good channel, very legit. I checked out a few of his videos, very informative, especially for retirees. There's a lot of stuff there on the RRSP, the LIRA, the kind of stuff we talked about. So I'll put the links in the video description below. And Adam, tell me a little bit more about those services that you offer, because I know a lot of my viewers are going to be interested, especially those, that have a lot of money. If you could do a good plan, it definitely could be worth the fee to save on all those taxes throughout your lifetime. So tell me a little bit about, the different services and plans, the consultation services you and your company offers.
For sure. Yeah. So we offer fee for service financial planning, which basically is, we get all your information up front. We gather it, go through it with you, make sure we understand all, and then we build out a financial plan. And where we do things a little bit differently, most financial planners, and if you've ever had a plan done at the bank, it's like they take your information, they plug it into software and hit generate and hand it to you. Whereas like that's step one for us. I mean, if we did that, we couldn't charge what we charge, because we're then going in and manual, like the RRSP Meltdown, and it's like this stuff isn't built into any software. We're manually doing that, and again, everyone's situation's a little bit differently. So we're going in there and grinding down. And again, we'll show you like, here's what you're doing and where you're at now. And then we'll kind of build it out and say, okay, you want to do this with your CPP and how to draw down your RRSP and this and that. And here's the difference at the end. Like here's net after tax in your pocket adjusted income is higher. Your overall tax bill while you're alive and at death is lower, and your estate's in a better position. So that's what we're doing. You can learn more at parallelwealth.com/planning. Is all the information, pricing. It's an individual plan right now. This will change if you're watching this video in 5 years, but $3,500 on the individual, $4,000 for a household or couple, and then $6,000 if you have rental properties or a corporation. And that's typically, we're kind of right in the middle of the ballpark as far as hiring a fee for service advisor. I'll say this, and I'm part of a Facebook group, your guys' Facebook group, and another one. And a lot of the comments I've seen is, financial advisors don't believe in passive investing and the concept behind it, and they won't build a plan around it. Sure, you might have had that experience. Again, we built a lot of plans for your guys' viewers on this channel. It works, and it's actually, the more income you draw out of your account, the more need there is for a plan. And so typically, like our typical plan, on average, we're saving $200,000 to $400,000 in taxes for clients. So it's quite, so for a $4,000 fee, if I said, hey, I have a $4,000 investment and I'll give you back 400,000 over the next, X amount of, it's a pretty good trade-off. So again, our website has a ton of information on there. It has a link to book a call with me. So I'll leave it at that.
Oh, I appreciate it. And I've met, I've done coaching sessions with some couples who have used your service that have, a million plus, and they were very satisfied. In my opinion, I mean, what's a $3,000-$4,000 fee when you're saving so much more than that over the years? Well worth it, in my opinion. So you have my endorsement. I'll put the information in the description below, and maybe we'll do this again sometime. I know I'll be coming on your channel soon. I can't wait for that. So again, it's nice to have you, and keep doing what you're doing, my friend. You're helping a lot of people. So
yeah, well, thanks for having me on. Appreciate it.
See you next time.
Sounds good.
Hey, don't go yet. I have some important reminders, including some more recent ones, and I'll try to keep it as brief as possible. And for everything that I'm about to discuss, the links and info are in the video description below. So first of all, if you didn't know yet, I do offer a one-on-one coaching session where you'll have a 1-hour Zoom call with me where you could ask me all the questions you want, and I'll help you and assist you best I can. Just remember that I am not a licensed or registered financial advisor or planner. So to book a session, go on my website, passiveincomeinvesting.ca, and button. Right there on the homepage on the left-hand side, there is a small video. Watch that video to know how to book a one-on-one properly with yours truly. Also on my website, you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once. And this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds. It has sample portfolios for both Canadian investors and American investors. So make sure to check it out on my website. I actually created a video which shows the product from A to Z because I don't want you to spend money unless you know exactly what you're getting. So make sure to check that video out on my website. And don't take my word for how good it is. Check out the reviews. There's over 300 of them, and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really, really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio so you could follow how my portfolio is doing live and what I buy every month. Really, really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada, you could drip everything you want. It has all the stocks and it also has dual currency accounts. Very, very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for PASSIV. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing, is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people, we kick them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe everyone, stay healthy, and of course, stay passive. See you next time.